All right, in this video, I'm going to talk a little bit about the various types of property coverage in a standard homeowners insurance policy. And it's actually going to be broken up into groups. So coverage is A, B, C, D, and then there are going to be a few others that are coverages that are not under the property category. Um, so let's talk about coverage A first. So the first coverage for homeowners insurance policy kind of makes sense. Letter A, first thing, the dwelling coverage. So this is basically the coverage for the home itself. And that's going to most of the time be replacement costs. So the replacement cost basically means it's going to cover the cost to replace the dwelling. So if it, for instance, burns down, it covers the cost to replace it. Now, in order for that to be applicable, there's often a co-insurance requirement. And this is basically saying that the coverage has to be within a specified amount of the replacement cost for full coverage to exist. And so basically what that's going to mean is if you have an 80% co-insurance requirement, and let's say the home is a $500,000 home, then your insurance level needs to be at least the $400,000 mark to make sure that you are within, say, 80%. So if 80% is the specified co-insurance amount, then I've got to make sure that my coverage is at least within 80% of the value of the home in order for that to be fully applied. If it's not, so let's say my coverage level was actually $250,000, and the full cost of the home is replacement cost is 500,000. So if that's the case, then I'm at 50% and not at 80%. And basically, what that's going to mean is I'm going to receive less coverage. So in the case of even a partial loss, let's say the losses were only $20,000 due to some damage. The home didn't burn down, just $20,000 of damage. Well, if the actual insurance level was still only 50% of the value of the home and the co-insurance requirement was 80%, then basically they're going to look at how much coverage I had relative to how much I had to have had, that 80%, in order to receive full payment. And they're going to basically do a prorated amount, and basically I'm going to get less. And so they're going to say, well, you should have had 80% coverage. You only have 50. So if you'd had 80, we would have given you sort of full coverage there. But because you don't, then basically we're going to give you a reduced amount of coverage for those that, $10,000 or $20,000 in damage or what have you. Okay. So basically the reason why they have this in place is to kind of, and the reason why there's some wiggle room in there is basically so that if your home changes in value a fair amount in a year, it doesn't cause problems for you with insurance. For instance, if I bought a home when it's $400,000 and the real estate market goes crazy, and in the span of a year it shoots up to $500,000, and I haven't renewed my policy yet, and then it burns to the ground. Well, the challenge you could run into is if we don't have sort of some wiggle room on this, where you're okay as long as you're at 80% or better, is that I can run into a problem where they aren't going to rebuild my house, and I've got risks here. So that's kind of the idea for why they have a little bit of wiggle room there. So really what you should do is have an insurance policy that ensures, the insurance amount is at the full value of the home. So that's kind of the idea. Okay. Let's see. You could also have, instead of a replacement cost, you could have a cash value coverage. So cash value coverage can be quite different. So, for instance, I remember seeing some articles a number of years ago about a metropolitan area that was had been significantly negatively affected, and that led to a substantial amount of homes that were, in some cases, moving to disrepair, but in general, just the home prices were just quite a bit lower because of the aftermath of some pretty bad recession effects. And so basically what happened was home prices just kind of plummeted due to some of the larger employers were gone and things like that. And so it was a serious problem. And so basically home prices were actually kind of low if you bought a house, because I mean the economic prospects of the area were not real great at the time. And so in that case, basically, if you had to pay to replace one of those homes, it would have cost a whole lot more. Whereas the cash value would have been what it actually cost to just buy the house. So there was actually a big gap between the cash to buy a house versus if you bought it and then it burned to the ground, what would it cost to rebuild it? Rebuilding it would have been much more expensive. And so if you have a cash value coverage, there is the risk there that if something occurs and the home burns down, but they're only paying what the cash value was, which might not be anything close to enough to actually rebuild it. So that's important to kind of keep in mind. Coverage B on a homeowner's insurance policy is going to cover other structures. So think detached garages, maybe a shed, something like that. And then oftentimes those will be limited by amounts. They might assess how much coverage it's going to have relative to the value of the property or the rest of the main structure, things like that. Coverage C is going to cover personal property, so think clothing and things like that, basically. Now, for personal property, that is generally going to be cash value. You can potentially purchase a little bit more coverage and endorsement to move that up to replacement cost, which would be even better. But it's generally cash value. And here's why that might matter. Let's suppose you bought a really large television, something like that. And let's just say that it costs, TVs have dropped so much that, let's say this really big TV, let's say it costs $500. Well, after a couple of years, it's a used TV, and so on a cash value basis, it's worth a lot less. So on a cash value basis, if your home burns down, they may only pay $150. And therefore, even with prices of TVs dropping, that may not be enough to actually replace with the same quality or same size. So replacement costs would actually cover more. But the reality is most of it is covering, in many cases, personal property coverage is on a cash value basis. So it's going to give you the cash value. So all those clothes that you bought a couple of years ago, you're still using them. Maybe it's your professional wardrobe, but it's a couple of years old. The retail value of clothing is not great. And so on a cash value basis, don't expect that it's necessarily going to pay enough to be able to replace every last bit of clothing you had in the same with new stuff with the coverage that you've got there. Also, for personal property, there are category limits. So there's limits on how much a typical policy will pay out for jewelry, limits for how much it'll pay out for silverware, limits for how much it'll pay out for gold coins or whatever that you had in the home. And so there are category limits. And so if you had maybe you're stashing gold bars under your bed, and the house burns down, or maybe your home is burglarized or something like that, they're only going to cover a certain amount, basically. And then there are limits on that. Now, you can potentially purchase an endorsement to increase the coverage on that. But in general, failing that, there are very specific category limits, and it's only going to cover up to a certain amount there. Also, it's possible that you can do a scheduled personal property endorsement where you list certain specific items of property and you get that covered. And so at additional cost, you could list certain specific other property and get that covered. But that would be at an additional expense. Coverage D is going to cover loss of use. So for the loss of use, imagine the situation in which your home burns down and they're going to pay to rebuild it. So we've got replacement costs. So they're going to replace the house. They're going to rebuild it. But it leads to this question then of, well, but where are you living while they're rebuilding it? And so the coverage D, that's what it is addressing. And basically, it's going to cover a portion of living expenses while the repairs, replacement, what have you, is occurring. And so basically, it's going to cover some of those kinds of things and help that. Now, typically, that coverage is going to be limited to a percentage of the coverage A. So let's say your house was $200,000, and that was the replacement cost under coverage A. And if let's say the coverage D is loss of use is limited to 30% of that. So basically, they're going to pay up to $60,000 of rental fees or something like that, basically, to help you live while you are waiting for them to rebuild the house that burned down. So you get some coverage, but it is limited. Okay, so hopefully this kind of broad overview of homeowners insurance property coverage has been helpful. Thank you so much for watching, and have a great day.